Hello everybody, my name is Drew Demon and I am the Devil's Stockbroker. In this video we're going to be covering the SPY and the latest market update. Mainly we're going to be focusing on what's been said by the Fed. So we recently had the FOMC decision and it did come in as expected. 25 bips rate hike, and that has essentially just confirmed the Wall Street consensus. This is exactly what we expected to see. We didn't get anything surprising, and at the same time bulls were completely caught off guard by this massive downside move, despite the fact that we were trading inside of this rising wedge, which had already tested resistance 3 separate times before we even got to the FOMC meeting. And even during the day of the meeting, we had repeatedly wicked through that area and got rejected multiple times throughout the entire hour that the FOMC meeting was occurring. The initial pump that came was basically because there was a 25 bips hike that was announced in the meeting notes, and that was exactly what Wall Street expected. So the biggest question that everybody has right now is where in the hell is the market going to go next? So let's go ahead and break things down just on the technicals. If we bring out the SPY down onto the daily, we can see that we have a few different technical patterns showing up in this. So the big one that we have been watching for the duration of the bear market has been this giant megaphone pattern that we had our breakout right here starting on the 20th of January. That was when the bull market rally brought the market back up by a solid 13%. Now we've pulled back and given up pretty much all of those gains at this floor of $380 per share. The ascending wedge does indicate that the market is going to retest this low at some point. I'm actually targeting down at 375 here for the next 2 months. So I'm expecting by the end of April or mid-May that we will see the SPY retesting 375. And I have swung some puts in the SPY as well as calls in SPXU accordingly in order to capture that move. In the near term, however, things are looking particularly bearish. Now, there's a few things that people have been discussing on in regards to the bank failures that have happened recently. There's been 3 major bank failures. The first one was Silicon Valley Bank, which supplied most of the liquidity and lending for big startup businesses in the California Silicon Valley area. Hence, it's their number one customer is small businesses in the Silicon Valley area. Signature Bank of New York also experienced a liquidity failure. And then Credit Suisse, which folks that you might remember that I was talking about them ever since about September. Credit Suisse, I was expecting to fail first. It was actually one of my number one targets for a big bank failure. So it's nice to be right. But given the circumstances, kind of wish that I was wrong. All the same, Credit Suisse is no more, and they're likely going to get absorbed by one of the major Wall Street banks, possibly J.P. Morgan Chase, Bank of America, or one of the other ones. Who knows? Point is, there is a systemic concern or a concern over systemic liquidity issues and failures at these different banks. Now, Credit Suisse, we know, was creating a lot of extremely over-leveraged bets. And one of the biggest concerns with Credit Suisse was that they were doubling down on their risky bets in order to recoup their losses, and of course did not work. So now that Credit Suisse is no more, they're trading below $1, which is insane to see a national bank of Switzerland to be trading at such a low price. You can see that I had been charting this for months now. Credit Suisse was a total disaster. Anyway, back to the point. There is concerns that there is a systemic issue with the banks. Whether there is or is not, people have been blaming the Fed and the increasing interest rates for why the banks are failing. No, that is not the reason why. The reason why the banks are currently having so many problems right now is because all of these banks have their assets tied up in the market. Banks have been tying up a lot of depositor assets in the market, and they have not been able to sell their assets in a quick enough fashion so as to remain liquid with their depositors and meeting depositor demand. This is the real reason why there is such an issue with liquidity in the banks. This is a personal savings rate chart, which is from the Bureau of Economic Analysis. And what this chart represents is the rate of deposits to personal income going into savings accounts. Now, when we initially had the COVID crisis, there was a major dump of cash into savings accounts. Part of the reason was a lot of people received unemployment and severance checks in connection with being let go because of the COVID crisis. A whole bunch of businesses were experiencing their initial, struggles with the lockdowns and all of that. And this caused a flush amount of cash getting shoved into people's pockets, and they dump that into savings because that's what you do. You save your money, you put your money into your savings account, and you prepare to weather the worst of the storm. People pulled their money out of the market, and a lot of cash exited the market very suddenly in the wake of the COVID crisis, and people put it into savings because we didn't know what was going to happen. Then a lot of people dumped that money back out into the market over the course of 2020, and we saw the effect of that. We had this massive bull run that occurred throughout the duration of the summer of 2020 and throughout 2021. The personal savings has since April of 2021 been depleted regularly. People are depositing less and less and less and less cash, and now we're well below the average of approximately 7.5% of personal income going into savings accounts. What this means is people are pulling money out of their savings accounts right now, and this is directly tied to inflation. So, inflation year over year has been still rapidly rising, and currently inflation is actually sitting at what is this? So the inflation rate currently, according to core piece CPI, is 6.5%. That's remarkably high. That's actually very high inflation. And this is directly translating into increased expenses for common household staples and goods. So, food, electricity, gasoline costs, everything has gotten way more expensive. This is directly correlating with the drop in personal savings rate. People are not able to save as much money as they were before. And as a matter of fact, this is creating a problem where people are now dipping into their savings regularly in order to pay for their their monthly expenses. This is the problem. You can see there's an inverse relationship with this chart just by looking at this. The orange line is the interest, or I'm sorry, the inflation rate year over year, and you see the personal savings rate. That's the percentage of deposits going into people's cash savings account. You can see there's a direct inverse relationship. When the inflation rate suddenly goes down, savings goes up because prices drop, prices suddenly decrease in everything. Then when inflation starts going up, prices increase, people can't save as much money. So the personal savings rate decreases. Now we're at a point where things have gotten so expensive, everybody is pulling their money out of their savings account in order to just make ends meet. This is actually a disastrous situation for the banks and is part of the reason why they keep blaming the Fed, because they are blaming them for the increase of interest rates, which directly ties into the expense of the money supply, but that's not the real reason. That puts pressure on the banks. The increased interest rate requires the banks to have more cash available in order to hold up their collateral obligations. But in reality, people being punished by inflation is causing depositors to pull money out of the banks. And this is forcing the banks to sell assets in order to kind of balance their balance sheet. What's going to happen if the interest rates don't start pulling inflation down? And eventually the bank vaults will be empty. So, despite the narrative of what people may be thinking, I'm pretty firm in my position that I think that Jerome Powell it was the Fed's right decision to make a 25 basis point hike, and they were very clear in all their statements that that is going to continue. I think that Powell capped it off at the end of his speech yesterday when he basically threw in the correspondent's face that there was no rate cuts in their base case plan. So, and that was all he had to say. So that's going to cover everything that I have to say about the market currently. the situation between inflation and, well, the SPY is that the market's going to have to come down, and people might not like it. It's going to suck, but it's the way it is. So I will continue to cover this throughout the week, and it's basically going to be the main focus of my videos going forward. And I apologize for my lack of presence lately. Work has been a little bit demanding recently, but hope to get back into a more regular filming schedule for the rest of the week. That's going to be it for me for this video. Thank you guys so much for watching, and I look forward to seeing you in the next one. But until then, have a hell of a time in the markets. Thank you guys so much for tuning in to watch this video. If you enjoyed the content and you found this information helpful to you in your own trading strategies, be sure to leave a like on the video. It helps out the YouTube algorithm and helps us reach out to others who need this information too. Be sure to subscribe if you want to see more. And if you're not a member of Hell's Trading Floor already, consider joining our Discord by joining us at hellstradingfloor.com, which will allow you to sign up for our Discord at discord.gg/hellstradingfloor. Thank you guys so much for watching, and I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.